Hello and welcome, Velocity Banking students, Kingdom citizens. How is everyone doing today? God bless you guys. If you're in the house, drop a few comments. Let me know that you're here. We have a wonderful guest with us today by the name of Heather, and she is going to help us understand the all-in-one loan product. So if you are here watching live or catching the recording, you are a client of mine already, or you're a loyal subscriber, you're part of maybe the Facebook community, private Facebook community, or you're on my email newsletter, so that's why you got notified of this. So this is a private event here, so be sure to drop your questions, your concerns, your thoughts all about this product. I know I have quite a few clients that are in the process of obtaining this tool, and most of you are doing research trying to discover a little bit more about this unique product that we can use for the velocity banking concept. Okay, so what I want to do, start things off, is just introduce Heather here. I'd like to just start off with just tell us a little bit about yourself and how you got into this, how you got involved in the all-in-one loan space. It's it's still a fairly unknown product, but it's been around for quite some time. So give us a little bit of background on yourself, how you got started, and where you're at today and what your focus is.
Okay, well, hi everyone. It's such a pleasure to be here with you all today, and thank you so much, Denzel, for having me. My name is Heather Amori, and I'm a loan officer with CMG Financial. I've been in the mortgage business for 4 months, so just past my 4-year anniversary, and I've been with CMG Financial now for just about 2 years. So I came across the all-in-one when I first came over to CMG because it is a proprietary company offers. And honestly, I've just been fascinated with the concept of it ever since the first time I heard of it. And since then I've become super passionate about the all-in-one loan. And because of that, it's been the primary source of my business as well. There's literally no other loan product like it that I've ever seen. And it's really cool to be able to continue to educate people about this type of product and the benefit of it for them. And it's especially cool being able to see them reap these benefits after their loan is closed. It was just a no-brainer to sell this to my clients. And before we really dig deeper into the product, I would just like to mention that since inception into the all-in-one loan has had 0 defaults. So that's thousands of families, billions of dollars in funded loan volume, and not one, like literally 0 defaults in 15 years. And that's remarkable. This loan is designed so well that it almost makes sense to mess this loan up.
Wow, 0 defaults. That's pretty interesting. I didn't know that. So the product's been around for 15 years, correct? And 0 defaults. So just kind of explain to
Yes.
people, kind of break that down. How does someone, obviously default on their mortgage? What are some precautions to avoid that from happening? I think that's just really interesting to understand, like how come like that is such a really good number compared to, another word for default would be foreclosure. Is that correct? Like another, for like a regular mortgage?
Right.
Got it.
Another.
Okay. Yeah. So break that down for us.
Well, so for starters, not okay. So one of the other governing bodies, like not Freddie Mac, Ginnie Mae, VA, FHA, not one of these other governing bodies can say the same thing, by a long shot. So it's remarkable just that the way it's designed, you almost can't default because it's just different than the way that a traditional loan is designed. To give a little bit of background on like how you can be foreclosed on or how you default is literally just not being able to pay your payments, right? And so much of a normal payment will go towards interest before it goes towards your principal balance. So whatever you still owe on your principal balance, now you're in default for that full amount.
Got it, got it. Thank you for that. I appreciate that detail there. That's really good to know, just for those that are looking into this product and just seeing the safety in it. Unlike traditional conventional mortgage, or even people that are getting home equity lines of credits in the second position or even the first. We can safely say that the all-in-one loan is probably one of the most safest products that we can use to leverage to accelerate the speed at which we pay off all of our other debts, but then the mortgage debt as well. So what I want to get into is tell me about just breaking down what exactly is an all-in-one loan, like just what does it look like and how does it work. Let's just start there and let's crack this open here.
Yeah, so before I get into really answering what the all-in-one is all about, I really want to give a quick background on just mortgages in general. So here in the US, we've been using the same method to repay our mortgages since the 1930s. So with how innovative and technically advanced we are as a country, you would think at this point there would be a wider product offering than what exists today. But the reason why we still use the same method simply because it's a reliably profitable way for banks to continue to make money. So in a traditional mortgage, payments that you make are going towards interest first, and the leftover goes towards principal. And then once the loan starts to mature, more of that payment will start to go towards principal. But unfortunately, we typically don't start to get to that point until about year 22 to 23 on average for a 30-year fixed mortgage. To me, that's insane. Not until you're 22 or 23 is when you really start paying more of your principal balance. So the way it's designed is to apply payments to your principal balance first and then pay interest only on the remaining principal balance. And in doing that, it saves borrowers tens of thousands of dollars in interest. So there's really four main benefits to the all-in-one loan. One is faster principal paydown, which who doesn't want to pay their mortgage off sooner? Two, as a byproduct of that, reduce monthly interest payments. Three, access to equity dollars without having to refinance or sell your home. And the fourth one is savings without any change in budget. Now, the reason why the loan is called the all-in-one is because there are three components to the product. It's your personal bank account, mortgage, and your home equity line or a HELOC all in one.
Got it. Can you repeat that one more time? You said faster principal payments, reduce monthly interest, and then what was the last two of the benefits?
So the third one is you have direct access to your equity dollars, without having to refinance, because typically if you want to get cash, you have to do what's called a finance. So this gives you that access to it without having to do that. And the fourth one is savings without a change in your lifestyle or budget.
Got it. And then the three components, you said it's your personal bank account, and then what was the other two components?
Your personal bank account, your mortgage, and your HELOC, which is a home equity line of credit. Those are the three components of it.
Got it. So when I have an all-in-one loan in my hands as a customer, is this, say, with my, like if I bank with Wells Fargo or Bank of America or Chase or local credit union, I'm still banking at the same bank, and I also have this separate a mortgage with a different lender, or is it all at the same bank with the all-in-one loan?
So you can opt to keep any current bank accounts that you have now. If there's reasons why you want to keep a separate bank account, you can definitely do that. Have the all-in-one loan. You will bank at the same place where your mortgage is held, and they'll actually be connected. The account at that bank will be connected to your mortgage, will also be connected to your HELOC. So meaning the same way that deposit and withdraw money into your personal bank account, you withdraw from your HELOC, that the deposits that you're making into your bank account, your mortgage simultaneously. So they're all connected in that way, and they'll all be held at the same bank.
Got it. Understood. So with that, what I want to get into is the pre-game work to actually get approved for one of these products with an all-in-one loan. So my first question is, what are some of the most, I'd say, most basic but most important requirements to get approved for the all-in-one loan? And with that, what are the costs and fees that are attached to the all-in-one loan that every consumer should be aware of, should be made known of? Is it like refinancing a mortgage where you have these different costs? Is there closing costs? Is it kind of works the same way like a regular mortgage, or is it totally different? So kind of break down for me, what are the requirements to get approved for an all-in-one loan, and then what are the fees that are associated with that that you can share with us today?
Okay, yeah. Well, the requirements to get approved for an all-in-one loan are very close to that of a standard conventional loan. However, since this loan has a personal banking feature, we do have investors who service this loan, and these investors look at the application as more of a banking portfolio rather than just a loan application. So there are a few additional requirements, like you do need to have a minimum credit score of 700, and you do have to maintain a certain amount in reserves, typically 10 to 15%, 20 typically on a purchase. So depending on if it's a purchase or a refinance. But as far as those things as well, like credit score, if your credit is not there, we actually are able to help you in different ways to get your credit up to that. And there are certain exceptions that a standard conventional loan would not have because these are private investors who are servicing the loan. So that also gives us a little bit of more flexibility to be able to get approved for the loan. And as far as the costs and fees, they're also, almost identical to that of a standard conventional loan. Actually, the only added fee versus a traditional loan is the $65 annual fee to keep the account open, which is waived for the first year as well. And typically closing costs are less for an all-in-one because you don't need to come up with for what's called an impound account. And a lot of times you do need to have an impound account when you're purchasing or refinancing a traditional loan.
Got it. So $65 annual fee. It's waived in the first year. We have the closing cost, like you said, is typically less than your traditional mortgage because you do not need to have an impound account. Is that what you said?
Yes.
Got it. So the fees are a little bit less there. And then in regards to requirements, have to have a 700 or higher credit score, 10 to 15% in reserves. Now that 10 to 15%, I'm assuming, is proportionate to the amount of debt that I'm getting on the particular property. Is that correct?
All right. And I didn't specify that, so I apologize, but it is 10 to 15% of the loan amount.
Got it. And then how much is required to put down on an all-in-one loan when I go to purchase a new property? Is it similar to the traditional, 3.5%, 5% down, or is there a set number? There's no budging when it comes to initially purchasing your property with an all-in-one loan.
Set numbers. So the minimum you're able to put down is 10%, and that is 10% of the purchase price. We have different programs within the all-in-one. So depending on who you live in, depending on the program that you choose, do require 20% down when purchasing. So it is between that 10 and 20%. And then in addition to that, you also have to have the 10% assets of the loan amount.
Got it. So we can safely say that when it comes to obtaining an all-in-one loan, it's not as easy as a regular traditional mortgage, number one, and you do have to have quite a bit of initial capital up front. So say, for example, I know me personally, I am looking to obtain a property somewhere in the neighborhood between 400 and maybe upwards of 500,000 in the South Florida area. So I would need to have 20%, between 10 and 20% for that down payment, so as low as 50K, right? And then also have an additional 10 to 15% in reserve. So, roughly over 100K, we could safely say is what I would need to have just sitting in a savings account. Is that correct?
For a purchase, that is correct. I wouldn't say that it is more difficult loan. There are certain characteristics that the investors do look for within the borrower. However, as far as the reserves and the assets, you actually can use a lot more than a traditional loan will allow you to. For instance, you can use 100% of your 401k, even if you're not fully able to withdraw that at that moment, you're still able to use 100% of that amount. You are also able to use life insurance policies as long as they have cash value. So there are a number of ways that, if you do have certain savings like that and not necessarily just cash in the bank, that you can use well.
Okay, that's very interesting. That definitely will raise some eyebrows for my clients, because a lot of my clients do own cash value life insurance policies. A lot of my clients are between the age of 45 and 55, so they have a pretty established 401k accounts, pension funds, things like that, or TSPs, 403bs. So I don't necessarily have to have liquid cash in the bank. I can use other assets, other tools to help get to that 10 to 15% reserve, correct?
Exactly. That's correct.
Awesome, awesome. So with that, we spoke about how before you mentioned private lenders service these loans. So that leads to my next question is, well, who offers all-in-one loans in the U.S., and is this available in Canada? I do have quite a bit of a viewer base in Canada. So is the all-in-one loan exclusive to the U.S., or is this being practiced in other countries like maybe Canada, maybe Australia, the UK? Would you happen to know that?
Yeah, so the all-in-one is exclusively only held with CMG Financial. And CMG Financial is licensed in all 50 states, but we are only in the US, so we're not in Canada, unfortunately, at least not now. However, I do know that the all-in-one is based off of what's called an offset mortgage. It is different than a traditional offset mortgage, but offset mortgages are what's mainly used, I guess, primarily in banking in many countries, like in Western Europe, in Canada, in Australia. So I know that they do have similar ideas to this loan, but it does differ in the way that it pays off your mortgage faster. And I can get into those details as well in just a little bit. So as far as offering the all-in-one in Canada, it doesn't exist there, but I know there are certain options that are pretty similar to it, that we've taken those ideas and created the all-in-one from that.
Got it. Yeah. For the most part, my community is familiar with the concept called velocity banking, but in Australia it's called mortgage acceleration, and
Yes.
they use offset accounts to accelerate their debt. The UK does it as well. I believe Canada has similar products. So, I would say maybe America is a little bit late to the game in respects to those unique strategies. So in the U.S. we call it velocity banking, but in a nutshell, it's debt snowball on steroids almost. Instead of making extra payments, right? Instead of making extra payments towards your mortgage, what we're doing is we're actually dumping our entire income into the all-in-one loan, and then you're taking funds out as we progress. So so with that, I'm not sure if you said it, I might have
Yeah.
missed it, but with the all-in-one loan, so only CMG uh, is exclusive that offers this product, or is there maybe other competitors, other institutions that provide similar products? How does that work?
So CMG is the only company who offers the all-in-one. Quick fact, actually, just because you brought up the other countries, and that this loan, when it was first made, it was called the Home Accelerator Mortgage Program. So very similar to that idea, in different countries. And actually, the founder of our company, he was visiting Australia. He was speaking over there, and while he was out there, he was curious to know how they do their banking out there. So he visited some different banks and he tried to find out, and that's how he saw, the way that they do their banking and how it's actually has more benefit for the client than it does for the bank. And as innovative as he is, he brought it to his own company back in 2005. And then, after a few years, it ended up being called the all-in-one because they changed different characteristics about it that actually made it more beneficial than a traditional offset mortgage. But yeah, so CMG Financial is the only company who offers it. I have never heard of another loan product like this in the US. So if there is another company who offers something similar, I have no idea. I have never heard of it. And I've never heard of anything even close to this, actually.
Got it. Thank you for that. So when I go to apply for an all-in-one loan, you mentioned how, we've got private lenders, so CMG is not a bank, correct?
CMG is not a depository bank. We are a mortgage company.
Mortgage company, got it. So CMG is the mortgage company. Would you be able to name some banks off the top of your head that my clients would be, essentially banking with? And would it be smart on our end as a customer to actually move our banking to that particular bank or institution to kind of build that relationship initially, and maybe that can help with the process of getting approved? Would that be wise to do?
I don't believe that it would have any effect on that. When you apply for a loan, there are certain guidelines that we have to follow, and an all-in-one loan does go basically based off of conventional guidelines, even though there are, like I mentioned, some different characteristics. So I wouldn't see a big benefit in banking with them prior to. And depending on where you live, at least for me in California, there is no physical bank that I can walk into if I had the all-in-one. They do exist in other states other than California. So that would make it a little more difficult to bank there for everyday use. But one of the banks is called Western Alliances Bank. That's the most popular one that we use just because of their guidelines and states that they're in. And then there are 3 other ones. 2 of them you can only have if you live in certain states. And the third one is probably the second one that we use as well.
Got it. So these banks, for the most part, are more so online, and like you said, only available in certain states. Like you said, California, there isn't a single bank in the state of California that you can actually walk into. So with that being said, when a customer, one of my clients, actually obtains the all-in-one loan, and the reason why I really wanted to communicate with you is because I have a lot of clients that are in California that have mortgages, or clients that are looking to obtain a mortgage. So I figured you'd be the perfect person to kind of help specifically in that area. So being that you can't actually walk into a bank, and to kind of give you a little background on my clients, they're generally on between 45, 55 and up. So they're kind of used to going into a bank and talking to the bank teller and making a withdrawal, making a deposit, cashing their check, and doing things like that. So with that not existing, does it make it, would you say, more convenient? I know for me, I barely ever go into the bank, so it's no issue for me. But for someone that's used to doing that, what's the transition like? Is there a mobile app, online portal, simple sign in if I needed to write a check, if I needed to, withdraw funds out of the all-in-one? Do I have like a debit card or a credit card? Kind of break down the functionality and the convenience of having an all-in-one loan.
Yeah, so it does. This account will have all the same functionality as their bank, other than you can't physically walk into the bank pending where you are at. So there is an online portal. You do get check card. You can use that debit card at any ATM, and you will get reimbursed for any and all fees that occur with using that ATM card. So it does have the similarities of any other bank. You can do automatic bill payments. You can transfer money, Zelle money, all of those same features. Sorry, I forgot what else I was going to mention. Oh, and you can also link it directly to other bank accounts with Wells Fargo, and you do like going into opt to keep that open, and you can transfer money through that account if you have certain bills that already go out of that account, and you don't want to have to change everything over to that. There's ways to link it for you. And in addition to that, you also have a full liaison team who helps you with everything. So a customer service number that you can call 24/7, team members that will help you transition with setting up all of these new bill payments into this account, and with your account numbers and how to use those for, your direct deposit and different things like that.
Got it. So if you could repeat that one more time in regards to when I go to a bank or any other bank ATM, did you say the word reimburse for any fees? Can you repeat that? I missed that part.
Yes. So you will be able to use your ATM at any ATM, and if you do get charged any fees, they will reimburse you for any.
That's pretty cool. That's pretty awesome. Okay, so I like that. So for people that
Yeah.
are taking notes, just jot that down. I just took some notes there, so that's pretty cool. When I'm talking to my clients and they're looking to obtain what I call a debt tool, such as a personal line of credit or a home equity line of credit in the first or second position, usually depending on their credit score, I usually, if they're below what the normal credit score is, I usually say, wait about 3 to 6 months to apply, get your credit right, your DTI right, and all that good stuff. So let's just say that I have the perfect credit score. I've got all the requirements. About how long is the process from application to approval to, closing on the home? About how long does that take?
So every borrower is different. So obviously every loan is different, and not every loan will take the same amount of time to close. But a typical all-in-one loan will take on average 30 days to close. Especially with purchases, we do have time frames that we have to, be on top of. So 30 days really the max on purchases. With refinances, it sometimes does differ, just because, like I said, every borrower is different. So all the characteristics of their loan are not always going to be the same. But on average, it does take about 30 days to close.
Got it. Thank you. And so 30 days to close, and coming back to the functionality of the all-in-one loan. So once I actually have it, let's say I put 10% down or 15% or whatever the number was, 10% or more. Is there a PMI attached to it or an escrow account? Is that as well all in one together, or is that going to be separate? How does that work when it comes to escrow and private mortgage insurance, things like that?
Yeah, so for mortgage insurance, if you do put 10% down, or if you do put under 20% down, you will have mortgage insurance, so you will have that PMI. It cannot be financed into the loan with the all-in-one, so it will be a monthly on top of your mortgage payment in essence. As far as your impound account, which is the same thing as the escrow account, the way that this loan is designed, it wouldn't make sense to have that impound account. So you basically don't. You're responsible at the end of the year, whenever your insurance and taxes are due, to pay that. But since you do have that equity in your account sitting there because you haven't been paying it every month, it can just easily be paid out of your account. So you will not have an impound account, but if you do have less than 20% down, you will have PMI.
Got it. So just like a regular mortgage, if you want to avoid the PMI, you have to put 20% or more down. And then in regards to the escrow account, there is none. So another word for escrow account is impound account. So I don't get that, since I'm not paying it on a monthly basis, since the money isn't sitting in an escrow account doing nothing. That money stays at work for me in the all-in-one loan, helping me actually pay down the account, giving me more access to equity. End of the year, or whenever the bill is due to pay the property taxes, I can pull it right out of the all-in-one loan, pay the bill, and then keep doing it. Keep dumping all my income in, taking expenses out, keeping my cash flow in, and essentially I'm ahead of the game every single time. So I really don't have to worry about setting aside money in a separate account. You might as well keep it all in the all-in-one loan, correct?
Correct. You might as well keep it in the all-in-one loan in order to keep that balance down as long as possible. So, and if I could just get into a little bit more of the detail of how the loan works. I know a lot of your clients are already familiar with the loan, but just to kind of give like a basic overview of it.
Yeah, go ahead.
Okay. So once you have it works, any deposit that you make into your go directly towards your principal balance, reduce the principal by the amount of the deposit. Now, calculated every single day. It's not charged, it's just calculated. So you're only paying interest on the remaining balance after that deposit has been made. And then obviously, we also have expenses, and whatever money you spend out of your account, the balance is going to go up by whatever the amount that you withdrew. But if this is calculated daily, it's still saving you money in interest costs because your money is working to keep that balance low before you need to. And it's calculated this way throughout the full 30-year loan. So as you continue to be cash flow positive, meaning more money coming into what's going out, every month you will start to see that interest only payment lower and lower. This is the only home loan in America today that will allow you this. And, you know, keeping your balance low means actually all this money in interest cost.
Got it. Thank you for that. I appreciate that. That definitely is clear now. Just to kind of repeat it once more so that people really hone in on it, because the internet was a little bit laggy there. So you only pay interest on what you owe, so it works just like a revolving line of credit, personal line of credit, HELOC. So if my mortgage payment is due on the 1st of every month, and let's say I get paid bi-weekly, so I get paid 2 times a month. Let's say I get paid on maybe the first week or 2 of the month, and then the last 2 weeks I get paid twice a month, and then there's those months where I get paid 3 times a month. Every time money goes in to the all-in-one loan, to be clear, money goes in, it satisfies the payment, the interest for the amount of days that it's been outstanding for, correct? And then when I get that following paycheck, when money goes in again after I've started, extracting money because I just dumped all my income in. So as I'm withdrawing funds, I'm only paying interest on what the balance goes up by for those specific days, right? And then when my next paycheck comes in, brings the balance down again, recalculates. And does the mortgage payment get pushed out, or does the payment still remain the same every single month? This is what's due. Kind of just one more time, just like get a little more detail on that, just so that people get clear on that, some clarity.
Yeah, definitely. So for starters, the payment that you're paying is an interest-only payment. In essence, don't have a principal payment anymore because any deposits that you make into the account are directly going to principal. Right away, as soon as that direct deposit goes in, any of your income goes in, any other go in, as soon as that hits your account, that will pay down your principal balance. And the interest is being calculated every day. So at the end of the month, the average amount of interest that was calculated over that is what your payment will be taken out for the following month. So it's an interest only payment. You still have your principal payment, but it's not like you're writing a check out. You are depositing money into this account, and that is paying your principal balance down for you. And the reason why it's so important that the interest is calculated every day, opposite how a traditional HELOC would be, is because for as many days as your balance remains that lower amount, you're only going to be paying interest at that amount. So yeah, we do have expenses and we do have to withdraw money, but those expenses come out periodically. They don't come out all in the same day typically. You don't pay for groceries and gas and your cable and your rent and everything all on the same day typically. So when they're periodically coming out of the account, for as many days before you have to spend that money, your balance is remaining low and interest on that balance.
Got it. Thank you. So with that, in regards to interest rates, what is the typical average rate on an all-in-one loan? What should I, especially in the low interest rate environment that we are in today, what would be the typical, credit score is like 750, high 700s or mid 700s. What is the, average interest rate that you have seen based on the loans that you've written across the U.S. or maybe specifically in California? What are those rates look like?
Well, for starters, the interest rate is almost irrelevant to this loan. With the all-in-one, it's not about what your interest rate is, but about the total cost of interest over the lifetime of the loan. Now, in saying that, the average rate right now is very similar to what you would get with a standard conventional loan. The borrower's rate will be the monthly LIBOR index rate plus whatever margin they decide on with their loan officer. There's tons of information on what the LIBOR index is if you don't know, if you're not familiar with it, but it does spend more time trending down than trending up, which that's a good thing. It is an adjustable rate, which can adjust every month, but there is a cap to how high it could go, so we don't let it indefinitely. And we do have two fixed options as well, a 3-year and a 5-year fixed. But really what I want to, make known to everybody is, most people go by this myth that if I get a low interest rate and low monthly payment, then I'm right. But low interest rates do not come with low interest costs. And I cannot stress that enough. So I'll say it again. Low interest rates do not come with low interest costs. And, the average that we see borrowers pay off their 30 using the all-in-one is in 8 to 12 years. So you can interest that's saving these borrowers. And again, without changing any spending habits, just changing the way that your money is working for you instead of working for the benefit of the bank.
Got it. So with the 3-year and 5-year fixed rate, what do those rates typically look like?
So typically, what is a floor rate? Like what standard conventional loan rates are right now. With the 3 and the 5-year fix, there is a little bit more of a cost to it. Pending on the margin that you want, that you decide on with your loan officer, it could be either a very small cost or it could be a larger cost. But again, that's totally up to the borrower. They would decide what margin they want. As far as the LIBOR, which is, what these rates are based off of, the LIBOR today, I think, is like 0.18%. So it's very, very low. And then our margins range from, 3% to like 3.75%. So you decide on what margin you want and you add that to the LIBOR rate, and that would be your floor rate that you would start out with.
Got it. So I've got a comment from Ruben. He says CMG average rate currently is 3.75 on a 30-year draw period. So would you say that's kind of like an accurate kind of, look at that for people that are looking at this? Like, okay, your total rate is probably going to be around maybe between 3.75%, and maybe a little bit higher on the fixed rate options. Was he going over adjustable, or was that the fixed?
So that sounds like it is adjustable if you don't decide to buy it down at all. That sounds like what would be a typical floor rate for this month, obviously. And that's because even if the LIBOR reached 0%, there still has to be a minimum floor rate that you would start out with. So right now it would be 3.75 if you're only doing adjustable and you don't decide to buy the margin down or get a credit to have your margin higher.
Got it. Understood. Okay. That's great. I like that. And so you had mentioned that the average all-in-one loan customer pays off their mortgage in like about 8 to 12 years. In this community, we like to go even faster. So we like to pay off all our debt, consumer debt, student loan debt, everything in about 5 to 7 years or less. So with that average, this is what my clients are typically ranging to pay off their mortgage debt and all their debt. Is about a 5 to 7 year window, maybe 8, but it's typically 5 to 7 or less. With that window, do you think it'd be wiser to stay with a just lock in a fixed rate, or stick with the adjustable? Now, typically, I know me personally, I think I would probably want to be with an adjustable, just knowing that if I can start off with a lower rate, and even if it does go up, the speed at which I'm going really has no effect as the rate goes higher and higher, because the debt is shrinking. So it's actually like less. It's not really hurting me, versus if I had a fixed rate, I got to deal with that the whole way through. And that fixed rate is typically higher than your starting adjustable rate. So what would be your answer for my clients, specifically my clients, my viewers that are paying off their debt in roughly 5 to 7 years on their mortgages? Do you say go with the fix, or ride it out with the adjustable rate?
Well, I think that you were spot on with what you said. That's why I say the interest rate is almost irrelevant to this loan. I would definitely say for most people, it's more beneficial to go with the adjustable. And it sounds like for your clients, especially, it's beneficial because, for one, you're not having that added cost that you need when you secure a fixed rate for that 3 or 5 years. And for your clients who want to pay off their loan in 5 to 7 years, they're going to be paying it off so fast that the interest cost over the lifetime of the loan is going to be so small in comparison to what that interest rate is. You can price out two different costs, and you can see with a 3.75 versus a, say, 3%. And what matters more is the total debt that you're paying interest on. That's what's going to matter in the long run. That's why this is, over the lifetime of that your loan will exist for, you're going to see how much that interest is shrinking down and down and down. So that's why I say the interest rate is almost irrelevant to this loan, and I would definitely school. And another additional thing too is, if interest rates continue to go down and your floor rate continues to go down, well, you don't get that benefit if you have that fixed rate. If you're right, if it starts to go up, which doesn't typically happen, you have that fixed rate. But if it doesn't do that and they get better, you don't get that benefit either.
Right. So being that we're in 2020, COVID environment, interest rates, Fed's rates, they're at 0%, and we could potentially be entering into a negative interest rate environment, which has never happened before in the U.S. before. So just based on current environment, current times that we're living in, and for the foreseeable future, roughly the next 5 years at least, especially with another stimulus on the way coming out, is we can make a safe assumption here that interest rates are going to continue to go down, and or they'll kind of stay the same. They won't really go up, because in a way that would really affect a ton of people that have already been affected because of the COVID environment, because of all the other the financial markets and different things that are occurring and things like that. So we can make that safe assumption, right? Interest rates are either going to stay down, go lower, but really we're not going to see it skyrocket. Yeah, I mean, even if it does go up, maybe a point, but nothing crazy over the next few years.
So that is definitely what's projected to happen, that they are going to stay low or get lower. It's definitely what's projected. Obviously, none of us know. We don't have a crystal ball, unfortunately, but it is what's projected to happen. And just to give a little bit more background on the LIBOR actually does follow the Fed funds closer than a traditional mortgage would. So we're going to see that relation a lot more than we would with like a standard loan as well.
Got it. So with that, coming back to the credit score, and getting approved for the all-in-one loan. I got a question that came in from Adam here. He says, what FICO score is used? Is it FICO 8, FICO 9? Got the Vantage. So what credit score is being used, and from which bureau? Is it TransUnion, Equifax, TransUnion? Would you happen to know those details?
Yeah. So whenever obtaining any mortgage loan, what they use is your mid FICO score, which literally, so it's not any specific bureau. It's if you have a 700, a 710, and a 720, they're going to use the 710. And that's the same way that we look at it with the all-in-one as well.
Got it. Thank you for that. And do you know which credit scoring version? FICO 8, FICO 9? Do you know which one that they typically kind of base their...
Right. I don't just because I'm not a credit expert, but anyone that any other mortgage that you would obtain would use, I would assume that it would be the same one as that.
Okay. Okay. So I'll definitely reach out to someone that I know in the credit space that could probably help with that. So that pretty much answers all of my questions. This has been very, very in-depth. I think this really helps a lot of people, look further into this product for first-time home buyers or experienced buyers that typically have been doing the traditional route. And, instead of using HELOCs, maybe they'll consider all-in-one loans. So actually I got one more question, which is, do all-in-one loans only apply to residential, or can it be used for like investment, maybe commercial in that sense, or is there some restrictions there?
So they do apply to both residential and investment homes. We do not have commercial in this space, but we do offer investment financing for this as well.
Awesome. So you do offer investments. That's really cool. So that'll be attractive for some of my real estate investor clients and people that do buy homes. And all-in-one loan, would we say that this is just for like single family homes, or could it be like on a duplex, triplex, fourplex? Is there like any restrictions around that? Mobile homes, things like that?
So anything over a fourplex, we would not finance with this loan. So anything
Right.
1 to 4, we would.
1 to 4, right? Because above 4, if I'm not mistaken, that makes it commercial, correct?
Correct.
Got it. Got it. Okay. So anything else that you want to share that you think we might have missed, that you wanted to talk about the all-in-one loan? Because I got all my questions answered here. I took a ton of notes. I'll be sure to type up something I can send out to my clients so they can just review everything. But lastly, as we close it out here, I'd like you to kind of share how people can reach out to you, ask questions, and in regards to if somebody wanted to work with you, do they have to live in California to get the all-in-one loan through you, or can you service multiple states? How does that work on your end?
Yeah, so currently I am only licensed in California. I am actually working on getting licensed in a few different states too as of right now. So, but like I said, CMG is licensed in all 50 states, and I do have a lot of connections with people in different states that I would be able to refer, your clients, my clients to them. And just, to let you guys know, if you did want to work with me and I wasn't able to help you because you live in a different state, when I refer my clients, it's not like, okay, here you go, and I never talk to you again. I follow up with you. I make sure that you can always reach out to me if there's an issue with the loan officer, if you want to change loan officers, whatever the case is. I'm very involved. So, even if you live in a different state, don't shy away from reaching out to this loan, because I can definitely help you and connect you with the right loan officer that's going to be able to help you as well.
Awesome. I appreciate that. Thank you so much. So anything else that you wanted to share, and please let us know maybe your email or contact number that we can that my clients can at least send an email to you and say thank you for coming on, and especially for my clients that do live in California, 'cause I do have quite a bit that are in the state of California. And I know I'm in South Florida. I've already been in communication with a CMG financial loan officer by the name of Ron Burke. I'm not sure if you know him, but he's the person that I got tagged to when I initially went on the site and had someone reach out. So so yeah, anything else that you wanted to share?
Yeah, so I just want to tell you guys a little bit about CMG Financial as a company. We are a full service lender, so we do everything. We do loans for first-time home buyers, and then we also work with, your high net worth individuals. We are direct with Fannie Mae, Freddie Mac, and Ginnie Mae. We are also the second largest privately held. We're like right there to be the largest, so we're almost there. Important, because it's one man who owns the company. And as I've already kind of talked about him a little bit, our president and CEO, he was also the outgoing president of the Mortgage Bankers Association nationally. So he was nominated and voted in to represent our industry at the highest level. And I only mention this to about who we are as a company and how innovative our leader is, and how he's created this loan off of other things that he's learned, and we've had it for 15 years, and there's been so many benefits to our clients. So you'll know that you're working with a reliable, credible organization. And I also want to invite you guys to, if done some research on this loan and you kind of want to play around with your own numbers, we do have a simulator that's available to the public, and it's on a site called aioloan.com. There's a video there you can watch, and there's also an area where if you click on Get Started, you'll be able to enter in your information and have a comparison side by side with either a current mortgage that you have or one that you're, looking to pair that with the all-in-one, and see how much money you'll save and how much time it'll take for you to pay off your loan in comparison to that loan. So that is a really cool feature. As far as my information, I can probably have Denzel send something out to all of you. But if you just want to jot down my information right now, I'm more than happy to give it out here. So my email is hamori, so H and then my last name, HAMORI, @cmgfi.com. And the FI is short for financial. And yeah, so that's my email. If you have any questions or you want to learn more about it, you can reach out to me. But as I said, I can also have Denzel maybe send you all out more of my information.
Perfect. Thank you so much. I appreciate you being here. Thank you for sharing all of your knowledge around the all-in-one loan. I will definitely, actually already have before, but I'll do it again just to remind people where they can find you, how they can reach out to you, especially if they are a resident in the state of California and you're looking to get a property there. Or if you just want to have a conversation with Heather, even if you're in a different state, and she can, like she said, she can tag you to another agent, and you can have, like you said, even you're not just gonna send them off, you're gonna follow up with them, make sure they're, being taken care of, and answering questions and things like that. So this has been fantastic.
Yes,
we'll close
definitely.
it out. We'll close it out here. Thank you so much for hanging out with us, and God bless to everybody else. Enjoy the rest of your day, and we'll be talking soon. Bye now.
Thank you for having me. I really appreciate it.